Hello, everyone. Welcome to today's February 2022 Reeds Trader Monthly Report. We'll be following our general format where Mark Boucher will be sharing his views, and then Chuck Whitman will be sharing kind of midway through the presentation some of his views. At the end, we'll open it up to a general Q&A session. We encourage you to use the chat window to go ahead and ask any questions you have. And then at the end, you'll be able to unmute yourself too. We can have a dialogue that way as well. In a moment, I'll be sharing the PDF that we'll be covering as well. And then for those of you that are subscribers, you'll be able to also download it from the Reeds Trader website. So with that, I'll turn over to you, Mark.
Okay. Remember, your trades are your own. So we've had a kind of a breakout in the 10-year yields. So central banks have been kind of tripping all over themselves to talk about how much more they're going to tighten that faster to catch up with market rates that we talked about before. The TNX has kind of gone through one of our favorite patterns, which is this sort of long base breakout of months to weeks and then flag and then a breakout of that. And that kind of offsets here the monthlies, which show that we've got some pretty steep resistance in this sort of 2 to 2.35% level. So there's probably going to be a little bit of battle there between long-term and this nice base breakout, and this probably has the bias of going higher. But a breakout over twos, my guess is that the market will not view that very favorably, start to show a little bit of reaction, except, for the financials and vehicles that like those higher rates. And then over 235, I think we close over 235 in TNX. That would probably elicit a stronger negative response from stocks we kind of want to watch out for. Right now, the market is discounting 5 rate hikes in 2022. With some analysts calling for as many as 7, plus QT to start in July. So that's a really steep pace of tightening. And it's not just in the U.S. It's basically last couple of weeks. We've had other countries now, all of them projecting much tighter policies, even the ECB. The only countries that are not doing that, Japan is going to be trying to swim against that, and China is basically way ahead of us, has tightened, seen a drastic slowdown, and is trying to cut rates to save themselves. They're a little bit ahead of everyone else, but otherwise, Europe, U.S., and most of the rest of the world is in a tightening phase. BOE is already tightened. The Bank of Canada is going to be tightening ahead of the U.S. So we're sort of on synchronized tightening phase that markets are going to be concerned about. And then this is one of Chuck's favorites that he always shows. It's really triggering now this month, which is basically junk bonds versus the S&P. And you can see that the junk bonds have been weaker than stocks and are actually have recently made new lows, which stocks haven't. That's a kind of giving us a warning, and B of A did a study that showed how the markets behaved in situations similar and haven't behaved particularly well. So it's a warning sign to kind of watch out for. And if we continue to get new lows there, that will continue, giving sort of an alarm. However, we don't really see a recession, right, unless there's some new substantial shock, new substantial energy shock developing on sanctions from war in Ukraine is a possibility, new rounds of COVID that set further lockdowns. Those are possibilities that could change that, but absent that, recovery seems to be likely to obtain, and we have very strong buybacks, some of the strongest ever projected, that'll put demand in the market. So we still think that downside is probably limited to around 20% based on prior large corrections. I also think that the over-indebted global economy and U.S. economy are likely to slow more sharply than authorities realize. If they raise rates the way they're talking about and tighten the way they're talking about, so that sometime later this year, either a slowing economy, more slow than the authorities would like, or a declining stock market similar to December of 2018 end of December 2018 are likely to lead to a shift in policy projections where they'll stop talking about more and more rate hikes and start toning down the degree of hike. You can see from the GDP now that this will be raised tomorrow when they give you the new estimate because of that strong NFP report, but it's still under 1% growth rate in Q1 compared to 6.9 in Q4. So it's still quite a degree of deceleration. That'll bring inflationary pressures off the boil some. That's from Omicron and other factors. We had a huge, both the third quarter and the fourth quarter had a huge input from inventory accumulation. Basically, prior to that, the inventories were very low and companies played catch up, but most of that is now, we've caught up to normal level of inventories. And so just to give you an idea of Q4, 6.9% GDP growth, 71% of that
actually came and took my advanced
came from the inventory accumulation. So we don't have that going forward. Goldman Sachs, for example, projects 0.5% in Q1, somewhere around 3.2% for the full year. So we're getting some deceleration that will hopefully bring inflationary pressures off the boil some. Now, we've been looking at the Omicron stuff, and so far, this is the South African, the first country that got Omicron and kind of the test case. So far, if you look at the 50 countries that have contracted the Omicron pretty broadly, they're almost all conforming to this pattern. You can see the U.S. it's later in the cycle, and most countries are later than South Africa, but it's similar. You get a big rise to high levels, and then you get this really quick decline. So Omicron is continuing to show milder symptoms, a much lower severe symptom rate, and vaccine and now some pills seem to be pretty effective at reducing severe symptoms, even for the higher risk groups with Omicron. And then, as we've said, the nature-made antibodies from those people who contracted one form of the virus and fought it, it tends to be the best protection against catching other variants. Vaccines really aren't doing a very good job of preventing people from catching new variants, but fighting the Omicron and or any of the other COVIDs in the lab and real time seem to be doing a much better job of giving people protection against future variants. So the more transmissible and milder Omicron may well continue to be the phase that repels the virus more substantially than anything we've seen. We're starting to see some countries shift from calling this a pandemic to an endemic, where they're dealing with the flu like they do more normally. And some of those are already underway, and we could see a broader renormalization of economies ahead if that continues. So our suggestion that Omicron is the beginning of the end of the pandemic still looks likely, and that would help improve growth and lead to a faster shift back toward normalization and demand of services versus demand of goods. It will also bring pressure off of inflation and will allow for production to pick up better because labor force is back here. So I think there's light at the end of the tunnel after a potentially substantial correction. Now, looking at, remember that our compass that we use is internals and what the market is telling us. And so far, the internals are not improving. They're actually worse than they were last month. So we haven't had any kind of improvement. Here, the supply gauge is in blue. You can see that it moves the opposite of the market. It's still above its trend line. It's still above its 40 DMA. It's actually made higher highs than the December corrective lows and highs in this index. So that's pretty negative. The spread, which is the difference between the demand and the supply and kind of a net indicator, also kind of universally negative. It's stayed below its downtrend line, stayed below its 200 DMA. And these are really kind of the first things that we would really like to be broken to see an intermediate term shift in the backdrop. We want this to spread to go above its 200 DMA, above this downtrend line. It's not, and in fact, it's below prior lows. Demand index has been stronger a little bit, tried to break out a little bit, but it couldn't hold and has broken the December lows. So it's relatively negative as well. Basically, historically, when the three indexes are in similar postures, they correlate with larger corrections in bear markets, and at very least bifurcated backdrops that are highly selective if there's any kind of an uptrend, and it's very difficult to outperform the market in that kind of backdrop. And also backdrops that are subject to substantial volatility, that makes the reward to risk relatively unfavorable. So our bias on an intermediate term basis remains somewhat defensive until that changes. Can really see very similar picture from the major internals. We have a nice advanced decline line, nice cumulative net volume, net points, new high, new lows, net new highs, and this is operating companies only, nice advanced decline line. Really, they've all topped and broken down from somewhere between 6 to 9 month ranges, which is a pretty negative sign associated with bigger corrections. And they're all below those breakout points and below the 20 EMA in sort of negative posture. The NYHL tried to bounce on this recent rally, but hit trend line resistance and backed off. But really, these are showing the same kind of posture that we're seeing out of our supply and demand indexes, that it's negative and hasn't really turned around completely yet. The big problem, again, is mostly small caps and mid caps. You can see the small caps broke down from a 9-month trading range. They've not broken above that level back into the range. So above 206, that would be the first sign of hope that maybe the rally could garner some more legs. But what we really need is, this is a small cap relative strength, and this is a mid cap relative strength, and you can see both are in severe downtrends and have made new lows. We need those to come up and break these former highs from earlier this year for there to be hope that there'd be broader participation from small and mid caps, which make up the majority of stocks. So far, we're not seeing that. You can see the backdrop, the S&P itself, has had kind of a break below those lows, tested the OCT lows and has bounced, but is in a downtrend line, is making on a daily chart at least a series of lower lows and lower highs. It's negative, and we got a lot really confluence of resistance at this basic high recently, and we're backing off of it. We haven't really seen, so in the bounce, we didn't see signs of demand dominance that we normally see at a significant bottom, so this rally is suspect for that reason. But in this decline, we haven't really gotten good volume traction. So we're kind of in an area where we're watching to figure out whether we're going to bounce up to this HVN up here before we get a final high in this rally, or whether if we break Friday's lows and we start to see volume traction down, we're likely to get at least a retest and possibly a break below these lows. If we close below this 420 level in SPY, that is a 7-month head and shoulder topping formation breakdown that will project down to this 3,500 to 3,800 next support level. So watching carefully how we behave if we get down towards a retest, and I would say retest is quite possible.